Welcome to this FX balance sheet hedging guide tailored for finance managers and directors in small and medium-sized businesses. This guide will equip you with the knowledge and tools to manage foreign exchange risks effectively through balance sheet hedging strategies. A surprising number of small and medium-sized businesses do not actively hedge their FX exposures. According to the British Business Bank, only 4% of UK SME exporters manage their currency risks. The reasons vary, from a lack of awareness to the perceived complexity of FX hedging strategies. However, the impact of not hedging can be significant, and this guide is designed to help businesses understand the benefits of hedging as well as the best practices for implementing it. Balance sheet hedging addresses one of the more visible aspects of how foreign currencies can impact your business and is often the easiest to implement. It aims to remove or reduce the noise of the FX gains and losses that often appear in the financial statements of companies that do business in multiple currencies. A well-designed hedging strategy can be a cost-effective way to improve your business's financial performance. It can also improve transparency on the profitability of specific commercial transactions that would otherwise be clouded by currency fluctuations. Balance sheet hedging can also be a stepping stone to a more comprehensive hedging strategy for businesses exposed to currency fluctuations. Companies where currency swings can heavily affect future profits or cash flows may also consider cash flow hedging, also known as forecasted transaction hedging. These more advanced programs are designed to immunize a business from the longer-term impact of currency effects on its operations. We will discuss cash flows hedging in a separate guide. In the realm of international business, FX gains and losses are a common yet often misunderstood phenomenon. FX gains and losses arise due to changes in value of balance sheet items that are denominated in foreign currencies. Exchange rates between different currencies move all the time and can affect the value of any item that has to be accounted for at its real value in one's home currency. Such items can be assets, such as foreign currency cash held on a bank account, or liabilities, such as loan drawn in a foreign currency. However, most often they come from accounts receivable and payable in foreign currencies. These typically arise due to the time lag between issuing and settling invoices in different currencies. This period, which can usually exceed several weeks or months, exposes businesses to the volatility of currency markets. When a business issues an invoice in a foreign currency, it locks in an expected revenue based on the current exchange rate. Similarly, when a company receives and recognizes an invoice from an overseas supplier or contractor, it commits to costs accrued on its balance sheet using the prevailing exchange rate on that day. However, until such invoices are paid, the exchange rate may fluctuate, leading to a gain or loss relative to the business's home currency. For instance, a UK-based business with receivables in US dollars and payables in euros may record an FX loss in their accounting records if the dollar weakens against the British pound, and a partially offsetting gain as the euro weakens by the time the invoices are collected. These FX gains and losses are reflected in a business's financial statements. An unfavorable exchange rate movement can turn a profitable transaction into a loss-making one. When these exposures are left unmanaged, the company's financial results are directly affected by currency fluctuations. In any given reporting period, FX gains and losses represent a cumulative gap between the operational and financial performance of the business due to currency effects. Hence, it is not just about the actual cash flow itself, but also the impact on the reported financial health of the company. Balance sheet hedging emerges as a solution to this challenge. It aims to neutralize the impact of currency fluctuations by creating a financial position that offsets the impact of exchange rate fluctuations inherent in foreign receivables and payables. The core purpose of balance sheet hedging is to minimize the impact of FX gains and losses, or more broadly, the effects of FX measurement on the financial statements. This stabilization is crucial for minimizing the variability in reported earnings and equity that can be caused by the changes in exchange rates. Improving transparency of cross-border commercial activity is often a secondary objective of balance sheet hedging. Currency swings can make it harder to understand the true profitability of different projects, contracts, or other commercial activities. By effectively implementing a hedging program, businesses can reduce the effect of currency fluctuations on specific commercial activity in any given period. Implementing a hedging program starts with a thorough assessment of foreign currency exposures. This means identifying all balance sheet items susceptible to exchange rate movements. Such items can include foreign currency receivables, payables, and loans outstanding and have not yet been hedged. Depending on the nature of the exposure, the business can adopt period-based or dynamic hedging strategies to mitigate the identified risks. This decision of how much to hedge is influenced by the company's risk appetite, the volatility of currency markets, and the complexity of underlying exposures. In its simplest form, hedging involves agreeing to exchange currencies on a future date. Although the exchange will happen in the future, FX rates and specified amounts are agreed upon upfront. So once the necessary amounts to pay or collect in foreign currencies are added up and netted for each currency and future period, the company can enter into one or several FX transactions with your bank or another financial service provider. These transactions involve currencies that are bought or sold to convert any net surplus or deficit in a given currency for future periods. As a result, the company will know with certainty the value of foreign payables or receivables, thanks to the exchange rates that are now fixed for the specified amounts. As invoices approach their settlement, respective financial transactions, forward contracts, can be drawn down in order to settle payments at the exchange rates that have been locked in by hedging. In the world of FX balance sheet hedging, the significance of timely and accurate data cannot be overstated. The effectiveness of any hedging strategy hinges on the promptness of the financial data at hand. For hedging to be effective, it's imperative that invoices, both receivables and payables, are entered into the ERP or accounting systems as soon as they are raised or received. Delays in this process can lead to outdated or incomplete exposure data, impacting the accuracy of hedging decisions. The ability to quickly assess currency exposures as soon as they arise is crucial. Systems like hedge flows can help with this process as they integrate and analyze data from various sources, providing a real-time view of the company's currency positions. With up-to-date data, finance managers can accurately calculate the amount that needs to be hedged. This precision is essential to avoid overhedging or underhedging, both of which can be costly. Integrating ERP and accounting systems with currency management systems such as hedge flows can streamline the flow of financial data. This integration ensures that all relevant information is centrally available and up to date. Setting up automated alerts for significant currency movements or when exposures reach a certain threshold can enhance the responsiveness of your hedging strategy. Period-based hedging is a structured approach to managing FX balance sheet exposures with a set frequency, such as weekly or monthly. This strategy relies on the regular identification and hedging of foreign currency exposures based on a predefined schedule. It can be aligned to other financial processes such as order or invoice matching or payment run scheduling for greater process efficiency. At the beginning of each period, the finance team assesses all foreign currency exposures. This includes identifying receivables and payables, as well as any current balance sheet positions that are not hedged. The finance team needs to ensure that all the exposures are accurate and account for any outstanding hedging instruments not yet used. Based on this assessment, the company then decides on the hedging instruments and the extent of coverage. The aim is to hedge the net exposure for each currency, taking into account any natural offsets that occur within the business. Consider this practical example. This UK-based company has several outstanding bills to pay in US dollars, as well as an existing cash balance on its US dollar bank account and a sales invoice to collect from a US-based customer. The company can enter a single FX forward contract for the purchase of $89,898 with a value date of 30th March, as earlier invoices can be offset using cash balance. By entering a single FX contract, the company can stabilize its FX-related impact, leading to more predictable financial results. Period-based hedging has its own advantages and disadvantages. This approach provides a structured and predictable way to manage FX risk, making it easier to plan. It is relatively straightforward to implement, especially for businesses without the resources for more complex strategies. While it offers consistency, this method may be less responsive to sudden changes in exposures or to changes in the market environment than dynamic hedging. It is an effective way for small and medium-sized businesses to manage FX risk in a structured and predictable manner. By aligning hedging activities with regular business cycles, companies can achieve a balance between risk mitigation and operational efficiency. Dynamic hedging is a proactive approach to FX risk management, focusing on the continuous evaluation and management of aggregated currency exposures in relation to preset risk tolerances and market movements. This strategy is ideal for businesses that face frequent and significant changes in foreign currency exposure amounts coming from payables and receivables. The first step in dynamic hedging is to define clear risk thresholds for different currencies. These thresholds dictate the level of exposure that the business is willing to tolerate before initiating a hedge. The simplest way to set the limit is in absolute amounts. For example, unhedged FX balance sheet exposures should not exceed £100,000 across foreign currencies. It is advisable to agree and document a hedging policy that defines the risk tolerance, hedging process, and authorize personnel in charge of making hedging decisions and executing hedges. Unlike period-based strategies that look at exposures in set intervals, dynamic hedging involves continuously aggregating and monitoring all foreign currency exposures. This includes constantly updating the net positions for each currency, taking into account receivables, payables, and existing hedges. Currency management systems, such as hedge flows, can streamline this process. Dynamic hedging requires a responsive approach to market changes. As the aggregated exposure approaches or exceeds the predefined risk tolerance levels, the finance team needs to make timely hedging decisions to realign the exposure to within acceptable limits. Dynamic hedging allows companies to adjust to market conditions in real time, providing more precise control over FX risk. By keeping exposures within defined risk tolerances, companies can effectively shield their financials from adverse currency movements. This strategy requires robust systems for real-time monitoring and experienced personnel capable of making quick, informed decisions. It may be more resource-intensive than period-based hedging. Netting is a crucial concept in FX balance sheet hedging, allowing businesses to streamline their hedging activities by offsetting exposures. This process involves consolidating multiple currency exposures, allowing companies to hedge only the net amount instead of each individual exposure. Netting starts with identifying currency exposures that are in opposition to each other. For instance, if a company has both receivables and payables in the same foreign currency, these can offset each other to a large extent. Where possible, the company can schedule the payments of invoices on the same day or after the receivables are paid. The finance team calculates the net exposure by subtracting the smaller exposure from the larger one. This net figure represents the actual currency risk that needs to be hedged. By hedging only the net exposure, businesses can significantly reduce the transaction costs associated with executing multiple hedging contracts. Effective hedging requires not only a good strategy, but also an awareness of potential pitfalls. Avoiding these common mistakes can significantly enhance the effectiveness of a hedging program. Overhedging and underhedging are among the most frequent errors in FX risk management. Overhedging occurs when the hedging position exceeds the actual exposure. It can lead to unnecessary costs and potentially lock-in losses. Conversely, underhedging is when the hedge covers significantly less than the exposure, which can leave the company vulnerable to FX fluctuations. Finding the right balance is key. Hedging activities should always align with the broader business goals and risk management framework. Misalignment can lead to risk management strategies that do not effectively mitigate the company's specific FX risks. One of the critical aspects of managing hedging costs is demanding transparency from banks and service providers, ensuring that all charges and fees are clear and justified. Understanding the costs of hedging and comparing them to the benefits is a critical part of robust decision-making. Hedging risks in some currencies may require additional regulatory compliance. Stay abreast of and comply with relevant financial regulations in all jurisdictions in which the company operates. Non-compliance can lead to legal issues and financial penalties. Maintain meticulous documentation of all hedging activities and ensure accurate reporting in financial statements. In conclusion, this guide has endeavoured to demystify the complexities of FX balance sheet hedging and provide practical strategies for finance managers and treasurers in medium-sized businesses. By understanding and implementing the concepts of period-based and dynamic hedging and leveraging the power of netting, businesses can effectively manage foreign exchange risks. As the global economic landscape continues to evolve, it is imperative for companies to regularly review and adapt their hedging strategies to remain resilient and maintain financial stability. This guide aims not only to inform, but also to empower finance professionals to confidently navigate the challenges of currency fluctuations, turning potential risks into opportunities for sustained business growth and success.